Hi, a very good afternoon, everyone. And thank you for taking the time to join us today. So the key agenda of our webinar will be to discuss RAM's views behind the AAA rating that has been assigned to Amanat's proposed Sukuk. I'm Devinder. I will be your host and speaker. And at a later stage, I'll also be part of the panel session. Before we start, some housekeeping. Your microphones will be muted. However, we'll be happy to take any Q&A that you have. Please type it out in the Q&A box. For best viewing, do use the speaker view. And finally, the slides will be available for sharing after the webinar, but please fill up the feedback form. So here we list the areas that we'll be covering in today's presentation. The webinar will be in two parts. We'll start off with the presentation, which will take us about 20 to 25 minutes. Thereafter, we'll follow it up with a Q&A. So starting off with Amanat's roles and responsibilities, it will be a unique issuer in our portfolio of highways in that it will have a dual role. So at one end, like any other corporate, it will be profit motivated. However, this will go hand in hand with its social and policy role. So Amanat has been tasked to fulfill the government's ambition on a few fronts, including the affordability of all the highways that it owns, to move into a zero or nominal tolling era as fast as possible. And most importantly, it will remove the fiscal burden on the government via eliminating compensation payments. So the setup of Amanat has been prompted by Gamuda's intention to exit the highway business while facilitating the government's call for restructuring of concessionaires. In terms of its day-to-day objectives, there will be two major ones. The first one being operational efficiencies. This will cover both KPIs as monitored by the Malaysia Highway Authority, as well as costs. And its second key role will be to repay its debt in as soon as possible manner. So strong governance will be at the heart of the Amanat setup, and the board is not expected to have any political affiliations. So it has been widely reported that Amanat will be helmed by 5 distinguished individuals who will not be profit motivated. To make it clear, they will earn a salary and some allowances, but not a return on equity. So from a rating perspective, a natural question is, how does this unprecedented ownership and governance structure influence our credit assessment? So critical to our assessment will be alignment of interests of all the stakeholders towards meeting common objectives. This is in addition to incentivizing the board to perform despite not earning a return on equity. To that end, a bonus incentive scheme, BERIS, has been put in place. So what exactly is BERIS? It is a tiered lump sum payout scheme that comes into effect once Amanat's Sukuk is fully repaid. So essentially, the sooner the Sukuk is fully repaid, the higher the payout. Additionally, to promote transparency, there is also a commitment to regular reporting. So the supplemental concessions were signed in April 2022 of the 4 highways that Amanat seeks to own. And under the supplemental concessions, the format in terms of reporting, both operational and financial performance, has been predetermined. So in terms of this particular structure, Sukuk holders will continue to maintain quite a fair bit of influence in terms of the board composition. And from a transaction comparability perspective, we view it akin to a leveraged buyout entity. But in this instance, the independent directors that run the company have added fiduciary duties. This is to the government of Malaysia as well as the public at large. So to cover the transaction details, in terms of utilization of proceeds, it will be dominated by 2 main fronts. The first being repayment to existing shareholders, and the second to refinance existing debt at the respective concession companies. In terms of repayment, it will be a fully amortizing structure, though it has been set up as a program. Any subsequent issuances will be subject to a no credit rating impact assessment and Sukuk holders' approval. This particular transaction also includes a call feature. It has been currently set at 11 years from issuance. So essentially by 2033, Amanat will have the option to fully redeem all remaining tranches under the Sukuk at par, failing which there will be quite a sizable step up in terms of the yields. So to be clear, our rating assessment does not factor in prepayment or early redemption risk, though we do highlight when the transaction will be fully cash back. So in our current rating scenario, it's expected in May 2035. In terms of stakeholders and counterparties, at the heart of any project financing is the contractual framework and project economics. In this particular instance, it will be the concession agreement and supplementals under the concession companies. The board as well as the shareholders will be there to ensure that Amanat meets its constitutional objectives. Assisting the board will be an oversight management service company. This will be made up of 6 individuals. Essentially, they are an executive team that will oversight some corporate office functions, such as accounts preparation, budgeting, maintaining of accounting systems, and treasury functions. And most importantly, we hope the prospective Sukuk holders who are in attendance today will be funding the transaction. So this transaction includes quite a lot of check and balances and influenced by the Sukuk holders with regard to board composition, refinancing, as well as acquisitions. So the transaction will count many firsts under its belt, both from an industry as well as a Sukuk debt capital market standpoint. First of which is the Sukuk will be the first highway to be issuing as an SRI Sukuk. So for those unfamiliar, the SRI stands for Sustainable and Responsible Investment. It's a framework that was introduced by the Securities Commission in 2014. And under this particular framework, the restructuring of the toll rates as well as the toll frees will be eligible as a category that under promoting the affordable basic infrastructure. Secondly, the company Amanat will be incorporated under the Companies Act, although the shareholders are not expected to be for profit. There are also the early redemption features that have been incorporated. It's common to see this in a perpetual instrument, but it has been accorded here as added flexibility. And finally, all 5 entities will be tax exempt and will not be burdened by any further toll rate hikes. So this will come into effect from 1st Jan 2022, once the condition precedent under the supplemental concessions are met. So before we delve into the rating drivers, it probably may be good to cover some of the key considerations that RAM considers when rating any highway. The 3 can be broken down into viability and bankability of the standalone project, or in this case, the 4 highways. Secondly, we'll look at the macro perspective. From a regulatory and policy front, what is the environment looking like? So while it has been a fairly volatile last few years for the highway sector, we still view policy support to be accommodative in that sanctity of contracts have continued to be honored. And finally, what are the covenants that are in place to insulate lenders to the risk of the specific transaction? So in terms of the first 2 factors, all 4 highways under the Amanat transaction cater to urban clang value, and they offer strong interconnectivity, be it to other expressways or toll-free roads. So the highways also cater to fairly mature and developed townships, and the performance has been resilient in the past, despite some challenges that it's been up against. This include past instances of toll rate hikes, the pandemic, as well as incoming of additional infrastructure like LRT and MRT. So of the 4, I think it's worthy to mention that SMART is probably the most volatile, despite its presence in the Golden Triangle, though of comfort is that it only accounts for 4% of cumulative revenue under Amanat. So as with any project financing, ring fencing and boxing up of risk is crucial. So the structural features under this particular transaction are fairly comprehensive. There are limits on costs, distributions, as well as controls on designated accounts. So collectively, in terms of the credit rating, it has been assigned a AAA rating anchored on the established track record of the 4 highways. resilient cash flows, as well as the structural features. So these collective factors will anchor the liquidity and debt servicing ability of the transaction to be akin to a AAA. So having rated highways since the 90s, in our experience, the two major threats to any credit risk for a highway transaction usually centers around traffic underperformance risk, and of late it has been land-related matters. While all four highways are brownfield in nature, we need not concern ourselves with land matters. So given the pandemic, it has been a volatile last 2 years for all four highways. And a key question today is, what does a return to normalcy look like for the highways? So RAM has used 2019 as a base, where the traffic registered just slightly above 965,000. And currently we're projecting a recovery to pre-pandemic levels only by end 2022. So we note that this may contrast with Gamuda's expectation of a full recovery in the next few months. However, we think there are some justifications to err on the side of caution, and hence we have imputed some buffers in terms of the traffic recovery. At this stage, I think we can't discount the possibility of new COVID variants or outbreaks, though we do recognize that the risk of a full-scale lockdown is a lot more remote today than it was at the start of the pandemic. So what does RAM look at when assessing the traffic demand risk of Amanat? I think we attempt to be as thorough as possible, subject to availability of meaningful and reliable data. So we look at a whole slew of factors as listed down here. However, what moves the needle the most in terms of the factors that we look at can be broken down into three main ones. The first is pricing and demand elasticities. So essentially, any factors that influence the cost of travel usually results in volatility of traffic patterns for the months to follow. Secondly, it's capacity constraints. Some highways are already facing congestion, and hence we are mindful about the growth assumptions that we assume henceforth. And finally, is upcoming infrastructure. So this is almost a limitation in that the infrastructure that can be assumed when assessing a particular transaction, especially during an initial rating, is limited to those that have details that are publicly available. So for the purpose of Amanat, the independent traffic consultant, namely Jacobs, they have assessed 5 competing upcoming infrastructure. This includes MRT2 and 4 highways. The 4 highways are SPE, Sukuk, Dash, and West Coast. So given that our transportation network is an evolving one, we usually assess traffic on any new upcoming infrastructure as and when more details are made known. So if you look at the past performance of the 4 highways, the highest that has been registered in the last 5 years is slightly above 1 million at 1,060,000 vehicles. So in terms of our projections up to 2037, we have currently used a number of 1.115 million. So if you assess it against the highest reached in 2016, 2017, it's about 5.5% higher over 15 years. The CAGR sits at about 0.8 to 0.9. So currently, I think it was mentioned during the investor session that rating agencies are excessively cautious in our traffic estimates. The motivation here is essentially to impute some buffers against any negative eventualities that are unknown today. So I think as we speak, the last few weeks has been quite horrendous. I think traffic has become the bane of everyone's day-to-day existence again, but it's still difficult to predict what the operating conditions in the coming years, especially 10, 15, 20 years from now will look like. So aside from traffic, the other major consideration for any highway transaction is the maintenance and expenses. So proper upkeep of any highway influences the lifespan, the flow of traffic, as well as is critical from a safety perspective. So under the Amanat cost structure, the main items will consist of maintenance expenses. This covers both engineering related costs, including civil, structural, electrical, mechanical, And this is followed by toll operations, resurfacing costs, as well as staff costs. So of comfort is that the cost applied under the transaction has been satisfactorily reviewed by the Malaysian Highway Authority. So as compared to other highways, the expenses under this particular transaction looks pretty well positioned and buffered. So if you were to look at RAM's cost analysis, we have excluded the 2 pandemic years as there were a lot of cost curtailments that happened in 2020 and 2019. And focusing on expenses from 2015 to 2019, the average across most highways is sitting at about 1.5 million per km per year. So in terms of the provisioning for this transaction, it currently stretches all the way from 2.2 to 3 million per annum. So this actually ends up at quite a comfortable CAGR of between 3 to almost 5%. And it stacks up well when compared against inflation, as well as the traffic growth CAGR that we have assumed. In terms of cost budgeting, it will be done on a group basis. There are hard limits that have been predetermined and set. We have not imputed any extraordinary spending at this point, although if there were anything to arise, it would be subject to Sukuk holders' approval. In terms of continuity, all the 900 staff at the existing 4 concession companies will be retained, and management are confident of meeting their KPIs under the SAA. Next, we'll move on into a few scenario analysis. We'll start off with the rating scenario. This has been presented in our rating report, where we have assumed a CAGR of between 0.8 to 0.9 from 2022 up to 2037. And the maximum ADT here is about 1.115 million. So to note is that in the first 3 periods of this transaction, only profit payments are due. And as a result, the FSCRs are particularly high. But thereafter, they will normalize to around the 2.25 levels. Worthy to note is 2034 onwards, you will see quite a dip in terms of the pre-financing cash flow. This is when the KESAS concession agreement ends. And subsequent to 2034, there will also be a rundown of cash reserves. So under this particular scenario, the minimum FSCRs are expected to sit nicely at 2.25 times, while the cash back situation will happen in May 2035, suggesting that should Amanat decide so, they can early redeem all remaining tranches by May 2035. Next, we'll move on to the second scenario. The difference here is that we have assumed that the growth traffic conditions are only conducive in the first 8 years, in that CAGR is only growing 0.7% up to 2030. Thereafter, traffic plateaus and flattens out. To note that this maximum ADT is even lower than the highs that were reached in 2016 and 17. Under this scenario, we have assumed actual cost is about 90% of the current budgeted amounts. So in this instance, FSCRs strengthened considerably from a minimum of 2.25 to 2.33, while the cashback situation is brought forward by a year to May 2034. And the final scenario is where RAM takes on a very conservative stance on traffic, where we use 2019 as a cap, and there are no further growth conditions to the highway. In this particular instance, we have used cost at a 75% of provisioning. So to put it into context, in the last 3 to 5 years, all 4 highways, in terms of actual spend to budget, has been hovering between 50 to 80%. So currently what we have used is the higher end of that 50 to 80% at 75%. So under this particular scenario, FSCRs hit a minimum of 2.35, while the cashback position will happen in May 2035. So what this scenario analysis suggests is that cost curtailment can offer some support for any future unexpected traffic underperformance risk. As far as liquidity is concerned, the transaction features support a strong buildup of cash, particularly in the later years. So in the earlier years, what you'll notice is repayment of principal and profit is still reliant on operating cash flow. But by 2025, the opening cash of the transaction to annual debt repayment over the next 12 months will sit quite nicely above 1 time. So we attribute this strong liquidity to 3 main considerations, namely being toll freeze, which provides earning certainty, the prohibition of distributions, as well as control of costs. So collectively, I think these factors will moderate downside performance risk and hopefully the risk of any leakages. In addition to project performance, structural integrity and boxing up of risk factors is also important in terms of preserving credit strength. So noteworthy under this transaction is the cash flow waterfall and designated accounts that will instill financial discipline. There are also limits in terms of the annual and monthly expenditure to be spent, and it's monitored quite thoroughly. There will also not be any extraction of profits by shareholders, as distributions are totally prohibited. And finally, there are additional features that are in place to further minimize bondholders' credit risk. So in terms of movement of funds between the concession companies and Amanat, there will be an intercompany financing arrangement where at the end of each month, all residual monies at the concession companies will be flowed up to Amanat via advances. All 5 entities are also tax exempt. In terms of termination and expropriation, the current supplemental concessions provide some coverage. Security arrangement is also there in case of any adverse untoward events. And finally, in terms of any one-offs, which include early repayment, refinancing, as well as acquisitions, these will be covered via an assessment of no rating impact, as well as Sukuk holders' approval. So in terms of rating tolerance as well as headroom, there are 3 main levers to the AAA, namely cost, traffic, as well as covenants. So as mentioned earlier, cost savings could provide support for both any traffic underperformance risk, as well as supporting early redemption. Secondly, any traffic performance that exceeds RAM's expectations will overall be a positive to the transaction. And finally, the transaction covenants are there to reduce the risk of any unexpected deterioration in the financials of the transaction, be it via excessive leverage or cash flow leakage. So with regard to the rating outlook and triggers, traffic and cost will be the backbone to this transaction. There is no upside to the rating given that it is assigned at AAA. However, to maintain the AAA, the transaction will have to continue meeting an minimum FSCR of 2.25 times. In terms of downward triggers, it will continue to circle around traffic as well as cost. And in terms of its outlook, we believe the outlook will continue to be comfortably anchoring the AAA rating in the next 6 to 24 months, given the resilient cash flows. So one question that we are anticipating is if the current Lytrac and Kesas transactions are rated AA2, while Smart is rated A1, how is it that this particular transaction is rated AAA? So one way of looking at it is that the current ratings are not project or company ratings. They are explicitly transaction ratings, which are anchored on cash flows and debt repayment matching. So in short, if Lytrac or Kesas were to retranche their repayment profile to achieve a minimum 2.25 times, it could be eligible for a AAA rating. So in closing, the Amanat issuance is quite timely from a traffic recovery angle. We are about 1.5 months into endemicity, and traffic rebounds have been fairly encouraging. Amanat, I think, if successful, may signal more restructurings to come. I think while future restructurings may not be direct replicas, concessionaires can still draw on some of the unique structural features that Amanat has introduced. In terms of tolling, there's a lot been said about RFID as well as multi-lane free flows. In our opinion, while it may be a few years away, Any technology that improves traffic flow will be welcomed, especially if it can reduce some of the capacity constraints and congestions of mature highways. Another preemptive question from the industry perspective is, will this particular transaction survive a change in political guard? So we think yes, but only if the sanctity of contracts continue to be honored, in that the government does not renege or amend any of the existing covenants and requirements such that it compromises project economics. So this is our wrap-up slide. The Gamuda and bankers are working really hard to close all the remaining loops, as well as receive the relevant approvals, inking of the documents, as well as meeting transaction, as well as supplemental concession CPs. So currently, issuance is targeted by the end of June. And prior to that, you should hear from RAM in terms of the issuance of the final rating. So depending on progress, these dates could move. And this will bring me to the end of the presentation.